Hi, everyone. Back to work. We're going to cover chapter 6 tonight. And so we're going to look at a topic called cost calculations, which is, it's a lot of math, but it is very practical. So I hope you like it. Anyway, so at the first part of chapter 6, we learned about the production function. We learned about the production stages. Stage 1, where your output is increasing at an increasing rate, and stage 3, where you have negative returns. We talked about all the different stages you can produce at. And then a final question is left, is all these different production stages, what's the most profitable? So that's what we're going to look at in chapter 6. The cost of your inputs and the price of your output. So in this chapter, we're going to look at cost categories, fixed and variable costs, cost calculations, total fixed cost, variable cost, total cost, marginal cost, average fixed cost, average variable cost, and average total cost. And then we're going to see how this applies to farmers engaged in a purely competitive market. So fixed costs are also called overhead. These costs are costs that remain the same at any level of production. So if you're given a farming operation, a good example of fixed costs would be something like the cost of a lease, property taxes, or your mortgage payment. Those are overhead or fixed costs. Variable costs, on the other hand, are costs that change as output changes. They increase as production increases, or they decrease as production decreases. Fixed costs, of course, are most important at low levels of production. So your overhead is high if you have a low amount of output. Fixed costs have a bigger impact on your costs at low levels of production, and that makes you inefficient and not profitable. So if you think about an almond farmer and he has a bad crop year, you're still paying the same amount of property tax. You just have less, ability to recoup your costs because you don't have any crop. So overhead costs remain the same, and at low levels of output, they are very expensive. Also, fixed costs are very difficult for the producer to change because they have to do with rent, long-term agreements, a mortgage, something like that. So it's very difficult to change fixed costs. On the other hand, farmer has greater control over variable costs. You can think about this pretty easily. If you're operating a dairy and the milk prices are low, you're going to try to control your variable costs. And the things that you can control are labor, perhaps change your feed ration, reduce your electricity use, consider other factors that have to do with variable costs. So a producer has the greatest control over variable costs, and by cutting your variable costs, you are increasing your efficiency, and that allows you to remain profitable. So remember, in a competitive market, the producer has no control over market price. Think about a dairy farmer. A dairyman does not set the price of milk. Milk prices are determined by supply and demand. Almost all of agriculture prices are determined by supply and demand. Consumers create demand, producers create supply. The interaction of those two create market price. Learn that in chapter 4. Primary way a producer can improve profits in a competitive market is to reduce your costs. And really the only costs that you can reduce are variable costs. So cutting costs means improving efficiency. So if you think about production agriculture, like we learned about in chapter 2, where you did the group project on agriculture in the United States, we talked more about efficiency and how farms are becoming bigger, how they have to become more efficient. And that has to do with the fact that farmers are price takers. Their market price is determined by supply and demand. It's predetermined. If you don't want to be a price taker, you have options of creating a new product. But in general, this chapter focuses on farmers being price takers. So the only way to make greater profit is to become more efficient, which means cutting your variable costs. So let's look at some cost calculations. Fixed cost is just a given. That's going to be given to you. Your fixed cost or your overhead. So to figure out your average fixed cost, that would be your fixed cost per unit of output. That could be your fixed cost per pound of almonds, your fixed cost per 100 pounds of milk. So you take your fixed cost and divide it by how much you're producing. 1,800 pounds of almonds per acre, 2,000 pounds of almonds per acre. So your fixed costs per unit of output are average fixed costs. Variable costs, again, have to be given to you. To calculate average variable cost, you take your variable cost and divide it by output. And that tells the producer how much of your costs are variable costs. And then finally, your total costs are adding your fixed cost, your overhead, plus your variable cost. So your total cost is what it costs you to produce 100 pounds of milk, a pound of almonds, a ton of alfalfa hay, whatever increment we're talking about. So total cost, your fixed cost plus your variable cost. Average total cost is the cost per unit of output. Average total costs are the cost per unit of output. So we take our total cost divided by output. We're going to do some practice on this. So marginal costs are the most confusing, but marginal costs are calculated by taking the change in total cost, that implies subtraction, divided by the change in output. So marginal costs equal the change in total cost divided by the change in output. Marginal costs tell the producer the cost to produce one more, or the cost of the next one. Very important in making economic decisions. So here's an example of some cost calculations from your book. The thing they're highlighting right here is marginal cost. I will have you note that this picture is in your book, and it has like a little formula here for each one of the cost calculations that aren't given to you. So you can figure out using column 2 plus column 4 gives you your total cost. So that might be helpful for you. So in this case, marginal cost. So we take the change in total cost, which the change in total cost is the change between point A and point B. And that would be 30, 180 minus 50. So your change in total cost is 30, divided by your change in output. Your change in output is 3 minus 1, that's 2. So 30 divided by 2 is 15. What does that tell the producer? It tells the producer that to produce one more output, that would be the second one, it's going to cost you $15. So that is the value of marginal cost, the cost to produce the next one. Okay, so these are just cost curves. If you were to go back and look at this graph, these points, and then you were to graph them, this is what they would look like when you graph them. So you can see one thing I was going to draw your attention to, average fixed cost, the more you produce as your output increases, your average fixed cost per unit of output diminishes. Your marginal costs rise, all the other costs are going to diminish and then slightly rise. And that has to do with the law of diminishing margin returns. What I wanted to draw your attention to is 2 points here. This is the shutdown point. And the shutdown point is when you can no longer keep your business running, obviously shut down. And that's going to be when your average variable cost equals your marginal cost. So basically at this point, you're not covering your fixed costs. Break-even point. That's pretty much common sense. That's where your total cost equals your marginal cost. The cost to produce each one is the same as the cost to produce the next one. You're going to need to know that for a question on the quiz, I think. Okay, so now that we've talked about costs, let's talk about revenue. So revenue is also called income. Either way, a book uses different terms, but I think they use the term revenue mostly. So as we've talked about, firms are most farming operations are price takers. And so let's assume that the price of corn is $3 per bushel. Revenue is the money coming into the business from sales. Cost is money going out of your business for things that you purchase. That's pretty common sense. Total revenue equals price times quantity sold. So if your wheat or corn is worth $3 a bushel, you sell 100 bushels, your total revenue would be $300. That's pretty simple. Marginal revenue represents a change in total revenue per unit sold. But if you just want to remember it easily, marginal revenue is the same as the price for your calculations. Marginal revenue is the same as the price per unit. Marginal revenue is the same as the price per unit. Okay, and if you want to be a profit maximizer, if this is your your profit maximization occurs where marginal cost equals marginal revenue. So marginal revenue equals marginal cost at $45. That is going to be where you're going to maximize your revenue. So if we put it all together, production function, beginning of chapter 6, showed various levels of input in a production process. We learned the law of diminishing marginal returns. Now we can look at a point in this production function and determine what it costs. As long as we're given the cost of the inputs and the price of the output, we can determine the profit. So we discussed the conditions for pure competition earlier in the chapter, the beginning of chapter 6. We identified the 4 factors of production: land, labor, capital, and management. And we learned that profit is maximized at the level of output where marginal cost equals marginal revenue. Just remember that. Marginal cost equals marginal revenue. And we are going to practice some of these things. So that's all for tonight. Only 11 minutes. Pretty short lecture. Lots of math in your practice problems, though. Good luck. See you next week.